What is happening, BiggerPockets family? It's Matt Faircloth on our Monday interview session. Thank you for watching. I'm grateful you guys are here, and I'm grateful to have this time with you guys because here's what's awesome about BiggerPockets. There are so many different ways that we can engage our investor community, and so many different ways that we as investors can talk to each other, right? You guys can listen to the BiggerPockets podcast, and you can listen to our guest today when he was on the BiggerPockets podcast, or you can read articles, and you can write comments back to the article producer. But in sessions like this, in these awesome live stream sessions, we give you guys something that you guys can't do anywhere else, which is to have one-on-one engagement live with the person that we're talking to. And I'm so grateful to have this space to provide this to you guys, because it's great to learn from people and great to hear their story on the podcast. And we're going to hear really awesome stories and really awesome conversations about investing while you're working full time. But we're also going to get to do Q&A with people. Quick shout outs. Adrian, I love you, man. Thank you for being here. I'm so grateful you're here. Hi, Dwayne. Hi, Tony. Thank you for being here with us today, guys. Now, before we get going, I want to give some more shout outs and some more high fives. So if you guys are watching right now, say hello to me. Type in where you're from. Tell me, hey, I'm watching from St. Louis, or I'm watching from Kansas City, and I love it when our folks from overseas jump in too. We have lots of people from overseas that are big BiggerPockets fans. So type in, hey, Matt, St. Paul, Minnesota. There you go. Tao. Welcome, Tao. So keep typing that in, guys. Keep giving me shout outs and start letting your fingers do the walking, because this is an opportunity for you guys to talk to a BiggerPockets contributor and to ask questions about real estate of myself and of our guests we're going to have today. This is supposed to be an interactive presentation. How are you, Kren from Durham, North Carolina? Welcome, and welcome, Jason from New York. Awesome to have you here. And we've got somebody from India, Amit from India. Awesome, awesome, awesome. I'm so grateful you're here. I've got Atlanta. I've got Lancaster, California. I've got Paul from Iowa in the house, and Trinidad and Tobago. Man, I'm so jealous, Kevin, that you're in Trinidad and Tobago. I'm sure the weather is incredible. And Sergio from Spain. Man, lots of folks I'd love to pay visits to. And Ricardo in New York City, of course. And Otis in the Bahamas. Otis in the Bahamas. You're just rubbing it in now, Otis, that you're in the Bahamas and we're not. That's okay. We're happy for you. So my name is Matt Faircloth. This is our Monday show that we do here on the BiggerPockets Facebook page. And yet again, I am, like I said, filled with gratitude for being here with you guys. This show has featured folks like Jay Scott. Ashley Wilson has been here with us. My wife runs a woman show on Mondays here on the BiggerPockets Facebook page. So be sure you catch that. She's got a couple of great guests lined up for the end of the month of July. So make sure you guys stay tuned for that. For the women out there. I've also had folks like Amanda Hahn talking about taxes, talking about the PPP loan. Here's what's great. If you guys miss those shows, you guys can watch the BiggerPockets Facebook feed or the YouTube feed to catch those shows in the past. And then be here or be square, man. Mondays. Today it's 3 p.m. Eastern. I believe we might have a different lunchtime next week, so pay attention to the BiggerPockets feed on that for an event announcement. So I'm grateful to have you guys here. Thank you. I'm going to go ahead and bring in our guest, man. Our guest. If you guys are going to love him, and if you guys like to hear what he has to say, you can check out more about him on BiggerPockets show number 74, one of the earlier BiggerPockets shows. And he's been a contributor for BP for 5 years, and we have an interesting conversation because a lot of you guys maybe love what you do. Right? You may love your job and you say, well, some people invest in real estate because I want to quit my job, but I love my job. And so we're going to talk about how folks that love what they do can keep investing in real estate while keeping their job. Not because they want to quit, because they want to keep doing what they do, but they want to diversify their wealth building in real estate investing. That's what today's conversation is going to be about. And so I'm super pumped to bring in today's guest. I think you guys are going to love the conversation today. So stick around for the whole time and start letting your fingers do the walking on the keyboard to start doing some questions here. Let's all give a round of applause and lots of thumbs up to welcome Jordan Thibodeau to our show today. Jordan, welcome, welcome, welcome. Thank you, man.
Thank you, Matt, for having me here. Really appreciate it. Thank you.
Awesome. Everybody give Jordan some hearts, give him some love, and give him some thumbs up here on Facebook and YouTube to help propagate the message in that. So, Jordan, I forgot to mention that you are the community manager for the Silicon Valley Investors Club out there in Silicon Valley. And thank you for your work there. And thank you for all the contributions you've done to BP, man. You having a good day today or what?
Yeah, I'm having a fantastic day. I'm just amazed to see how BP has grown. When I first reached out to Josh and Brandon back in like 2013-ish to have them come over for an interview. It was just like them working at the company. And now to see they're like 1.6 like million members and this awesome Facebook Live that you guys have. I mean, it's just amazing to see where you guys are going.
It's been a blowing up community. I just like you, I'm grateful to be a part of it. I'm grateful to have seen it in the beginning and to see the enormous growth. So a lot of people want to know about your family. I got people want to know if you know Tom Thibodeau or if you know David Thibodeau or whatnot. Not sure where that comes from, but if these are family members of yours, you're getting some shout outs here.
Thank you. I wish I was related, but probably have much more money, but fortunately not. But yes, the Thibodeau name runs strong here. So there's the EAU and there's the X, and there's like a legend behind that story. Maybe I'll talk about that for another episode. But
yeah. We'll have to do a happy hour talk on that one. But that's, right. That's a cocktail conversation, right? But I wanted to talk to you today about something because at the end of the day, a lot of folks myself, I've been investing full time for 15 years. And that's because when I quit my job in 2005, I had a job that it's not a job I didn't like, Jordan. It's a job that I hated, man. And I was not wired for the job that I had. And it was either, okay, go get a new job or try entrepreneurship. And Rich Dad Poor Dad spoke to me. I had done some real estate investments while I was still working. And it just seemed like a good angle to take to, okay, I'm going to try real estate investing full time. That said, I know plenty of people that are in careers that they love, not just like, they love with an L what they do, right? And I know you've told me that too, that you really enjoy your career. So why would you build a real estate investing business that replaces that job when you can have both, right? And so what I want to talk about today is how folks can scale to that and can do, and there's pitfalls that you could step in and the investing work that I was doing was causing like a lot of, like it was overflowing into my day job. Right. So at the end of the day, I felt like I needed to quit so I could really scale. So tell us a bit of your story on how you were able to build an impressive real estate business while holding down a day job. How'd you do it?
Yeah. Well, I mean, first of all, we live in an age right now where there's so much information that's at our fingertips. And with BiggerPockets, I was able to get so much data and just learn about the real estate market. But I was also blessed by having a family who's been involved in real estate for multiple generations. So my great-grandpa used to buy apartment complexes in Boston, and my grandpa and my dad started buying single-family homes here in Silicon Valley. And so they were buying from like the late 60s onwards. So my family saw like multiple recessions, even like a depression in real estate. We saw the savings and loans crisis. We saw the financial crisis. And now we saw this COVID situation. So growing up, it was always like implanted in my mind that like there's going to be great opportunities to get into real estate, and there's going to be opportunities that you might want to like kind of pump the brakes. But at the end of the day, though, the most important aspect is having like a job, or either having a business that kind of serves as a cash machine that will allow you to get involved in the real estate market when it's a good opportunity to buy. And then when things get crazy, allows you to kind of like pump the brakes. You don't feel too dependent. You have to always like be involved in the market. And I think with a full-time job, I look at it as a superpower because the last couple of years, I mean, the FIRE movement's been really big, and I think the FIRE movement's fantastic. It's a great ideal to strive for. But the FIRE movement started right after the depression or the financial crisis. And so you saw stock market returns like just go from the bottom all the way to the top. So everyone's portfolio was considerably increasing. Real estate valuations were going crazy too. I mean, since 1950s onward, the average return of like appreciation plus rental yields about like 8%. But from like the 2011, 2012 time period, 2019, you're seeing like 17%. So during that time, everyone wanted to quit their job, and you look like a working stiff to say, I want to stay in a cubicle and work 24/7. But then once COVID hit, people were like, oh, wait a minute, my tenants aren't renewing, the stock market collapsed, where's all my income? Whereas people who actually had good jobs were still receiving paychecks and still doing pretty well. So I think there's a superpower in having a job if like the earnings, the healthcare benefits, the 401k plan, which is fantastic. But then the ability to generate free cash flow that you can use to deploy towards real estate investments. And another thing people don't focus on is the fact of when you have a job, you have 8 a.m. to 5 p.m. to focus on this job, and you must be focused. But then that kind of bookends your time. So then you can say, okay, I only have maybe a couple hours per day to get involved in real estate. I need to make sure that I'm not spinning my wheels. So what some entrepreneurs run into this issue is like, once you quit your job, you're like, oh, wait a minute, I don't have a manager involved anymore telling me what I should be doing. And then you start getting involved in all these crazy things. You don't know how to focus yourself. Whereas the full-time employee who's trying to invest in real estate on the side, you have to tell yourself, okay, well, if I'm working a full-time job, that means that I can't get involved in the most time-intensive aspects of real estate, which would be like fix and flips, maybe getting involved in really labor-intensive burst strategies. So you tell yourself, okay, well, then what strategies might work for me? Probably simple buy and holds, maybe getting involved in syndication or getting involved in REITs. And so that kind of allows you to narrow your focus so then you understand, okay, what I really should be putting my time in for investing in real estate. And the pressure of going like helter-skelter looking for opportunities.
Yeah. What's interesting, Jordan, as well, is I found, and again, I quit my job in 2005. And when I did that, I was still buying a 3-family, buying a 4-family, or trying to do refinance on properties that I owned already. And the biggest, like one of the superpowers, which I love to use that analogy, one of the biggest superpowers that a full-time job gives someone with a full-time job, it gives you that W-2. And whether you find this to be a true asset or not, banks view W-2s as stability, and they want to see W-2 income coming in that they can use to calculate your DTI ratio. And they view a W-2 as bankability, right? And that is an enormous superpower above folks that do not have full-time jobs on asset classes. Let's say you're buying something, say 30 units or less or something like that. Anything above that, the banks start to view the asset itself as producing the income that you need. But below that, they want to see a W-2 coming in beyond it, or some sort of regular, whether it's W-2 or not, they want to see some sort of regular stream of income to come in to qualify for that debt. And we used to have to get co-signers. We would have to, or my wife was working full time. And so my wife would have to come to all my closings because I didn't qualify for the debt myself. And she'd have to take the day off to come to my closing with me just to sign off on a mortgage. So I love that superpower analogy that you gave that a full-time job has, on top of the 401k and stock investments, another thing that you can do to participate pre-tax in the market. And I guess you were referring to perhaps being able to roll that through self-directeds. If you change jobs, you can roll over to self-directed and do some real estate investing passively as well, if you have a job as well. Correct.
If you're interested in doing that too. I'm very pro like asset allocation, having buckets for stock, having a bucket for real estate, maybe some venture capital in there too, and other types of assets. One thing I learned from my family was that by the fact that we had a business going, we could develop cash flow that would allow us to continue to pick up properties on a regular basis. One thing I see people do is they will use a real estate portfolio, and once they have enough equity in their properties, they might pull out for HELOC and continue to add debt upon debt. And you can roll your debt and buy more investments, but at the same time, you're actually kind of increasing your leverage.
Sure.
So that if financial catastrophe happens, you might not be able to stay in the game. And so the big thing I preach to people working full-time jobs is like, what can you do to make sure that you're not exposing yourself to death line risk, which can prevent you to stay in the real estate market? That's
great stuff. Yeah. Keep the questions coming, guys. Let's let your fingers do the walking and pump some questions in here for Jordan, and that to talk about. Let's talk more about doing investing while you've got a full-time job. And listen, you don't have to love your job. You don't have to want to keep it. But you could even build up enough passive income with your full-time job through what Jordan's talking about here. You can build up enough passive income to leave that job eventually. But unless you've got a spouse that's working, or unless you've got enormous cash flow coming from something, you may have to continue to work in a job that you don't like for a while until you've got enough passive coming to leave it. Or, as Jordan's referring to, you can keep that job that you like and just keep passive coming in as a way to build your wealth. One of the two. This is a strategy that really fits a lot of folks. So let's pump some questions in here to pick Jordan's brain a little further. I've got a question. You talked about the different buckets that folks can invest in as a working passive investor. Right now, obviously, there's stocks and the paper assets and things like that. But from real estate perspective, what do you think should be the focus of someone who's, let's just paint an avatar of somebody who's listening to this right now, has a job that they like, they don't want to leave, they've got some resources and some equity. What should they be looking at to do?
Yeah, that's a really good question. I would first look at it as like, how involved do you want to be in this real estate portfolio? Do you want to be the one who's like managing a property manager or managing the properties yourself? Do you want to be making decisions on which properties to acquire? And also, like, how liquid do you want this investment to be, and how much exposure do you want? And so with the buy and hold strategy, the REIT strategy, syndication strategy, they all have like strengths and weaknesses relevant to themselves. So like for the buy and hold strategy is like, you're calling the shots on what property you're going to acquire. No one's going to tell you like when you have to get out of the investment. So a syndication, it's like most of them are like, this is a 5-year hold, 10-year hold on a specific property.
Yeah.
But then after that 5 and 10 years hold, you get your money back and hopefully return, which is great. But now you have your money back. Now, let's say the apartment complex was a steal and you could still be holding on to that and continually getting that great cash flow. But unfortunately, the syndicators need to exit. So now you get your money back and now you have to figure out like where to reallocate that. And it could be in a booming market. So you might be increasing your risk. Whereas buy and hold, no matter what the market's doing, you're still holding onto that property and you're getting all the benefits. But on the negative side for buy and hold is you have to make sure that you're finding the right property manager and you're taking care of that, because a lot of time is focused on finding the right real estate agent, but the money is made on the property manager because they are the ones who are going to day in, day out manage your property. And if they don't do it properly, then you're not going to make enough money on the rent and enough cash flow to make this a good investment. So I would look at your time. And then if you're thinking like, well, I don't have a lot of time and I want to invest, but I might want to do a concentrated play, a syndication could be an opportunity. But when it comes to syndication, what you need to do is it's very hard to find good deal providers. For instance, Realty Shares, in order to get on their platform, they like look at all the syndications that are coming in. And caveats, Realty Shares is actually the company's closing down. But when they were open, because it was just the model didn't work, but when they were open, of the deals that would apply, like they would turn down 90% because most syndication deals aren't that great. And so for people who are new into that type of investing, it's really important that you field in a lot of offerings so you can look at them and start to do pattern recognition of what makes sense and what doesn't make sense. And then the other bucket to look into is real estate investment trusts, which are kind of just like buying a stock. They're the most liquid way to get in and out of real estate. And it's very easy because you can even buy it in your 401k, or you can go to a brokerage house and buy some shares. You get instant diversification. The downside, though, is, when a financial catastrophe happens and the market gets hit, you're going to see a live valuation of like, oh, your portfolio of $1 million is now worth 500,000. And I don't care who you are. It's very hard to not act upon that. You want to sell. Whereas if you have buy and hold real estate or syndication, you're not, besides Zillow for buy and hold, but in most part, you're not every day getting briefed on what the value of your property is. So you're not feeling that emotional stress if you have to exit that position.
Yeah, no, I get it. I mean, that you really spelled a lot out there. If I could summarize it and see if I got it there, REITs and things like that are very liquid because they can be traded on the open market. That's one of the beauties of real estate, of most real estate investments, by the way, is because they're illiquid. You can't just sell, like I can't sell my house, and have the cash in my pocket tomorrow, right? Because of the illiquidity of real estate, it tends to keep the prices more stable than other liquid assets can be. You can't have a run on the bank and sell out half of a liquid asset. Love what you said about direct real estate ownership versus syndication. And I've always versed it because we put together syndications in my company. We do them fairly regularly, but what we've told people is that you are giving up some ownership or some like control and some profit in exchange for our time. And what the syndicator does, the syndicator puts in that managing of the managers that you referred to, directs the asset, manages the business plan, cracks the whip when it needs to happen, which is all things you'll have to do if you own the real estate directly. But you own the real estate directly, you get full profit, you get full control, sell it when you want, hold it when you don't, or hold it in perpetuity, right? And so it's one of those, you've really got to do the trade-off and maybe even a blend across the board. So I think it's a great summary. Tons of questions here. Nima wants to know, and you may not know this, and if you don't, that's okay, because I've got a reference point we can make to Nima here.
Yeah.
How do taxes work when you take out a loan from your Roth 401k account?
Ooh, that's a good question.
I know. And I know you and I are both not, unless you are, I don't believe you're a CPA. Yeah, I'm not either. So we can defer, or would you like to take a crack at that?
I would like to defer to Menahan, but I will say one aspect of it. So there's your standard 401ks, which are deferred taxes, where basically you earn some money, instead of paying taxes on that, Uncle Sam says, okay, we're going to not tax you right now, but then when you're like 65 and beyond, you take withdrawal, we'll tax you then. So you get to use this pre-tax money to make an investment. Then there's like the Roth. And what's interesting about that is the federal government's always changing the constraints on it, but you pay after-tax money, you put it into this account, and then the principal of that money can grow. And then when you take it out in retirement, that principal isn't taxed because you originally were taxed when at the beginning when you put the money in there. That initial money that you did put into that account, though, if you wanted to, you could pull that out and use it for something else, but you have to put it back in with X amount of time, or you'll lose the opportunity to like reinvest it.
Right.
What I suggest to people, though, is if you have your 401k in your primary account and that's like your main like retirement nest egg, I would say hold off on pulling money out of the account to go invest in real estate right now. I would say instead figure out other ways to save money on the side for your first down payment, because nothing worse of you taking something that's diversified in your 401k and an index fund and then putting it in a concentrated real estate bet where you're new to real estate investing and you making a mistake, which is now going to put your whole entire retirement account kind of in jeopardy. So
got it.
Yep.
Got it. Okay. No, that's a good point. I mean, it's kind of like a handle with care, kind of thing. It's like somebody handed you a hand grenade with the pin pulled out. So you got to do something quick with it before it goes off on you, right?
Yeah.
Anthony had an interesting question here. Anthony said, I work at the post office and I'm looking to invest in a rental property. Is $75,000 a good amount to start? I'm assuming that Anthony may have $75,000 in cash, and I think that's what he's looking to put to work. So Jordan, what are your thoughts on $75,000 as a starting point to invest in real estate?
Well, Anthony, thank you so much for the question. It's very open-ended, so I absolutely love this. So I look at it as like when I started my journey investing in 2013, I ended up buying a duplex in Sacramento, in like central Sacramento, for $140,000. And my down payment was like $37,000. Great times now that those times are long past. But when I had my down payment, I had enough cash, at least 6 months of mortgage payments, and plus a big balance for like capital expenditures in case anything happened or repairs needed to be made. We had a strategy to refurbish the duplex, so I knew I would need to have extra cash outlays. So if I'm assuming that $75,000, if you're asking like, is this enough to get started investing? I would say yes, but you should not look at it as I'm going to buy a property that requires a $75,000 down payment. You should look at it as maybe I'm buying a property that requires a $40,000 down payment, and the rest of the cash is breathing room for capital improvements and other things that need to be fixed. Because it's very important to have that margin of safety in case the unexpected happens. I've had so many investors I've spoken to who've bought really great cash flowing properties, and then it turns out the roof needs to be fixed or the sewer main breaks, and now they have a gigantic expense that they really can't afford to cover because they put all their money into one deal.
Yeah.
Another thing I wanted to kind of bring up, it's kind of riffing on this, but like, let's say he was saying, should I buy a property for $75,000? My question would be where is this property?
Yep.
Do you know if it has good demographics? Like, are there more people coming to the area than they're leaving? And then also, what are the key economic drivers in the economy? This is very important for me because like anytime you invest in somewhere, you want to know the overall like components of the job market. If something is geared too heavily on one type of job or career, all it takes is for that industry to go under, and then your whole entire market's put into jeopardy. So for instance, Sacramento, I invest in core of Sacramento because I like that area because there's schools there, there's hospitals, it's near the government. There's a burgeoning tech scene happening. But then if you go on the outskirts of Sacramento, There's more open land, it's more suburban, and prices are cheaper. But because there's so much more land, you're competing as developers. And if a major employer goes out of business there, you're going to see the whole entire area wiped out. So there's a place called McLaren Air Force Base, which is north of Sacramento. During World War II, they were producing they were repairing P-39s that were being sent in the Japanese theater to fight the Japanese army. And in 2001, that Air Force Base got shut down, and 11,000 people lost their jobs in that area. Wow. Which is really sad. Which once that happened, crime rate skyrocketed, drug use skyrocketed, real estate prices got hit. And if you just bought there because of the Air Force Base, you're kind of get destroyed. Just like when people who just buy next to a certain college town. As we saw with COVID, there's some colleges that are not going to be opening in the fall, and now they're doing work from home, or they're going to virtual commute. So then why do I need to have my kid pay for rental in that area? So think about those things. And also, the last thing people don't talk about a lot is crime. Understanding the aspect of, like, if you're buying an area and you're getting a cheap property and it's a high crime rate, by doing that, you're asking yourself for a lot of headaches. So far as property managers are going to be more expensive they're going to charge more to manage your property. So instead of charging 6% of gross rent, they might charge 10% of gross rent. You're not going to get the best tenants. You're going to have higher vacancies, and you're not going to be able to charge as much for rent. So going back to the question, thank you for asking that question. And there's a lot of things for you to think about, but I think you're going along the right path if you take those things into consideration.
Lot to unpack there. Yeah. To your question about this, I was going to say the $75,000 that Anthony should not put all that money to work in one deal. Cause I think that when I first got started, the one thing that I really didn't factor or put enough weight on was, as you said, repairs you got to make, but just operating capital. You should have, a certain amount of months worth of expenses, months worth of debt service, just sitting in your company checking account. And you've obviously, and going back to another thing, you should not plan on operating this thing out of your personal checking account anyway. You should set up another checking account, even if you own the real estate in your own name, and or whatnot, but just set it up another account and have that be the operating account for the real estate. It's a good form of checks and balances and everything like that as well. But you need to have some padding in that account, as you said, for just in case money, God forbid, you got to replace the roof. But also just sometimes you've got to just front expenses, or maybe you lose a couple of tenants. You have to deal with some vacancy. You've got to have, Anthony, some reserves to just pay bills out of, and not rely on a rent check to come in until you can pay a bill.
Exactly. So right now, when COVID happened, I've been lucky that my tenants haven't been hurt that hard in Sacramento, but I reached out to them right away and I was asking for their situation. And as like a sign of goodwill, being that I was able to buy the property at a good price and I have a lot of reserves, I decided just to give them some credit on the rent, lower their rent, just to make things easier. So we're all in this together and struggling together. But if I didn't have reserves, I wouldn't be able to be so generous towards them. So you make a really good point about being able to have that. So
absolutely. Jonathan Brown wanted to know, coming in off of YouTube. Thank you for your question, Jonathan. Wanted to know, do lenders consider 401k balances when looking at an investor's reserve holdings? I do believe they look at your 401k when it comes to your assets, but are they looking at that as a reserve as well? Like, case of emergency break glass kind of money that you could tap to. What do you think?
Very good question, Jonathan. Thank you for the question. Really appreciate that. So for the mortgage lender I worked with when I originally qualified, he did not look at my 401ks, and his rationale was that money you have in there is for your retirement, and if you have to pull it out, you might have to pay prepayment penalties, or there might be a situation where you have to pay it back early. And so we more focus on current cash you have available, maybe stock you have in the brokerage accounts, and your current earnings and other assets. We do not look at your 401k account. Now, you might find other lenders who are different, but that's just kind of the way it is. Back in 2013, even, most mortgage lenders were not looking at your uninvested equity. So if you work at a startup or whatnot, or an established tech company, they will give you an allotment of shares, and these vest over time. And some of these employees have all these shares and some invested, but traditional mortgage lenders would not look at that as income. But here in the Valley, the only way to afford a house is if you have those shares. And now most mortgage lenders in the area will look at your shares as income and allow you to qualify with that.
Got it. Good stuff. Great answer. Thank you. So Well, we're gonna gut Eddie on YouTube also. Man, Facebook guys, you guys got to catch up here, man. YouTube is blowing out YouTube. YouTube is just blowing out Facebook today on comments, man. So you got a lot of YouTube fans, Jordan. Eddie wanted to know, can you walk through your portfolio and how you were able to scale with just buy and hold? Now, I'll reposition this a little bit.
Mm-hmm.
Buy and hold is like you're buying a small stream, of cash, and it may generate a couple $100, may generate $1,000 or $2, but it's tough through that stream to fill up the larger pool of money that you need to buy your next rental. Now, again, after you have enough, you've got a nice stream, you got a bunch of streams of cash flow, and it turns into a river, and that's awesome. So could you cover for Eddie how someone with a full-time job can, create those, the equity needed to buy your next rental?
Right. It's a really good question. So typically, like for my family, when we started purchasing our properties, we got very lucky that we're investing in Silicon Valley, where when we got our first property, my dad was going to faint at closing. This was back in the 70s. And he's like, there's no way I'll be able to pay this back. And he went to my grandpa and was like, what's the price? And like, they want $26,000 for this 3-bedroom, 2-bath house in Santa Clara. There's no way I can pay for it. And then now $26,000 won't even get you a postage stamp here in there. So things are really different there. But if you look at like just a standard old buy and hold, and if it's cash flowing somewhere of like you're getting a couple $100 a month on top of your expenses or whatnot, or just doing pretty well, that money is going to take maybe like 10, 15 some odd years for that one little buy and hold to be able to like actually get you a down payment on something else if you don't leverage it. And I'm not very pro on leverage. There's people who love doing leverage. I think when you get your 30-year fixed mortgage, it's enough leverage for me. I'm good on that. But this is where your job component comes in, and other cash sources of earnings that you can do, where it's like, okay, I bought my first buy and hold. Now I need to save up more money, so then the next 2 years, 3 years from now, I can get my another buy and hold. And then hopefully over that time, rents will continue to increase. I can pay down more of my debt, and then the buy and hold that I'm slowly buying, that rental income will become large enough to help me get other down payments. It takes time to get this going. Now, another person could say to me, well, why don't you just take a HELOC out and just pull all this money from it? Like, yes, you could pull a HELOC out from your properties, and you could do more leverage plays. We have to understand is that you're taking on more risk. And that's something that you have to be okay with doing. I'm more the side of, I've seen so many people get financially ruined with too much leverage, or not thinking about the negative sides of debt, that I'm more on the conservative side, where I say, hey, yes, I might miss out on buying multiple properties per year or something, but that makes sure that I at least have enough cash in the bank to protect myself in case something wrong happens. So
it's great. It's a great point. It's a great point. So, okay. Timothy wants to know, and you can take a shot at this. This is, this isn't, there's another one that's asking you, another question here where they're asking you to break out your crystal ball and tell us what's going to happen in the future, but we'll get to that one in a second. This is more current events and about the CARES Act. Timothy wants to know, yet another YouTuber wants to know, how does the CARES Act affect withdrawing your retirement accounts from real estate? I don't know if you're familiar with it. But as you know, the CARES Act has changed the regs on that. What are your thoughts?
Right. So I'm not, first of all, Timothy, thank you for the question. I'm not an expert on this. Like, from what I do know is you can pull money out now for like a COVID related reason, and your 401k provider is going to say, okay, if it's COVID related, go ahead and do what you want. But then I believe you have to, there's some type of payback or period or something. I still don't think that you should be withdrawing from your 401k, even if it's for a COVID related reason or hardship withdrawal, just so you can get started in real estate investing. I know some people would say, no, go ahead and do it. And this is me coming from experience. So back in 2013, after I bought my duplex, some other opportunities came up, and I had a chunk of money in my 401k, and I could have done a withdrawal. I could have taken out like another $50,000 from my 401k and have to pay it back in 5 years. But, hindsight's always 20/20. Everyone now could say to me like, oh, well, you should have taken money out of your 401k and bought all those properties. You'd be much better. But after the financial crisis, things could have gotten either way. People try to act like now, oh, we all knew things were going to get better and the economy's going to do well and blah, blah, blah. But no, Remember how you felt when you saw the Dow go down 50, 60%. Remember how you felt when you saw hundreds of thousands of people losing their jobs. Like, the policy was going to collapse. So yes, there are people who use their 401k to invest in real estate, but like, it's a really risky proposition. And I usually tell people, like, there's got to be a better way you can do this by either saving up money, getting a 30-year fix, maybe doing not doing 25% down payment, maybe doing 20 or something, even though you get PMI. But there's got to be other creative ways you can finance this without just saying, I'm going to pull out of my retirement to make a play in real estate.
Absolutely. Yeah, I think you're right, and I think it's the CARES Act is a short-term thing. Could be a big old hornet's nest you're stepping into there on pulling out your 401k to invest in real estate. Now, Google Maniac is asking you to pull out your crystal ball, and I want to see what you have to say here. Will the government restricting evictions and forbearances? With the government restricting evictions and forbearances, which you're seeing a good bit of on eviction restrictions, and I think I'd read that California is talking about no evictions till 2024 or something like that, or something crazy. I don't know if that's really passed yet, but there's conversations in that. Do you see the housing crash, a housing crash that may happen sooner than later because of all the restrictions that the government's putting on rental real estate?
What a great question. First of all, thank you, Google Maniac. I'm a little bit biased here because I work at the company, so thank you. But one thing is, a lot of people have experience in the stock market. And when we think about the stock market, we think of like NASDAQ, we think of NASDAQ, New York Stock Exchange, and whatever happens in one bit of the country will affect the global stock market. Well, the real estate, there's no like one real estate market. It's like just thousands of different markets across the country that do all different types of things. So when the financial crisis happened, and also, past performance does not guarantee future results, but I just want to use this example. When that happened, there were parts in Sacramento where real estate prices went down 60, 70%. It was like the end of the world. And then if you went to the area where I'm living here in San Jose, Willow Glen, nothing really happened. Like the market kept on going, more executives kept on moving in, and nothing really happened. So talking about a housing crash, when someone says that, I really can't give like a broad, like, first of all, I don't know what's going to happen next year, but also I can't give a statement that's going to cover all markets because different markets are doing different things. There's like certain parts of San Francisco right now that are seeing rent dips. There's certain parts of San Jose that are seeing rents doing okay. I mean, so what I like to focus more on is looking at your particular market. If you think there is going to be a crash or a slowdown, are your properties in the position to weather that storm? If they're not in a position to weather that storm, what can you do right now to make your properties more competitive? Also, like to kind of look at, if you look at the financial crisis and what happened, we didn't really, a lot of people were hurt in the financial crisis, but we didn't feel the full pain of it because the Federal Reserve pumped in $4.5 trillion into the economy and took all that bad debt and put it onto their books. And then around 2016 or 2017, 2018, they started selling back some of those assets and the whole stock market kind of crashed a little bit. And they said, okay, no, we're not going to do it. And then now the Federal Reserve is putting on trillions of more dollars into dollars. So what I think about is there's two factors at play right now. There's the bullish case for real estate and there's a bearish case for real estate. And I don't know which one's going to win, but the bullish case is that we are in a situation where there's not enough housing in the United States of America. The Federal Reserve is pumping out so much cash that this is going to create an inflationary environment that is eventually going to lead to people who have mortgage debts and real estate seeing more appreciation, and they're going to be able to use cheaper future dollars to pay back more expensive dollars from the past. So, and basically their debts are going to become cheaper. That's kind of like a bullish case. Then there's the bearish case, which basically says what could possibly happen is the U.S. government is pumping out so much money, we're going to lose our reserve currency status, meaning China and the other foreign powers aren't going to be willing to take U.S. dollars, which to then put our situation where America could face some type of like economic catastrophe, which is going to could hurt possibly the whole entire country. And then also due to the baby boomers retiring in droves, there's going to be more downward pressure placed on real estate. So as far as crystal ball, to reiterate, I would focus on your set market that you're looking at. And then I would look at like how, if you think there is going to be a crash, how do you think it would play out in your market, and what can you do to protect yourself from it?
Great answer. Thank you. Speaking of looking at your specific market, Shalini has a great question, yet again, coming in off of YouTube. I am a physician and I want to invest in multifamily units in South Florida. How do I get started? The housing values here are so overpriced. Do you see a correction for multifamily? Now, I want to split up Shalini's question into two questions here, right? For you, Jordan. So number one, Shalini lives in South Florida. First question, do you need to invest in your own backyard? Number two, what do you see in the future of multifamily, short and long, like short-term future, long-term future for multifamily?
That's a great question. So when I got my first property in Sacramento, it's about 2.5 hours away from me. And so it was like it wasn't out of state, definitely, but it felt like a quasi long distance property. So like if I bought property down the street, if something bad happened, I could just jump on my car and come fix it. But when it's 2.5 hours, it's like, do I really want to go drive up there? So I really have to make use of my contract network, people I know in the area to get stuff done. When you decide to go out of state, that's a situation where if you don't have the right network and people in place, it's going to be very hard for you to get started. And what I suggest people to do is, after you've done your research so far as like what markets and what city you want to invest in, and you're confident that you've written like your one pager of like, this is the positive aspects of the city, here's the negative aspects of the city, and this is my conviction of why I want to invest in there. And it's really important to have that conviction, because when a recession does happen, if you don't have conviction, you might sell your property too early and you're going to miss out on a potential recovery. Just like people who sold their properties in the Bay Area in 2006, if they would have held on to now, they would actually be at least breaking even or making some money. Once you find out your market, then Shalini needs to get on the phone and start speaking to multiple real estate agents, property managers, and get a flavor for what they have to offer and what they think about the neighborhood she's thinking about investing in. And what's important is I have a lot of real estate agents I refer some of my colleagues out to. And a lot of people think like, I'm just going to go to a realtor and tell them I have a lot of money, I want to invest in something, and they're going to jump at me and help me out. No, realtors get those calls all day long, all these flash in the pan investors who say they're super interested in real estate, and they do a 15-minute phone call and they never talk to them again. You need to be able to come out to them saying, hey, I have an investment plan. This is where I want to invest. I'm qualified for this loan. This is what I want to do. And talk to them that you have a vision and know where you want to go. And that right there will let them know that you're someone who's interested in getting started in real estate investing. So interview these people, build up your list, and then if you can, get on a plane and go down to the area and see things for yourself. Because you're never going to get truly like 100% unbiased information from someone who is just going to make money off the short-term transaction. You need to be able to put everything in perspective, because there's one thing looking at data, there's another thing actually being in that neighborhood and seeing how it operates. So then you can actually put things into context that makes sense. Now,
go ahead.
Go ahead.
No, I was going to comment on the multifamily on the multifamily market. I've got my thoughts. I'd love to hear what you have to say.
Oh, yeah. So do I see a correction in multifamily units? Like, again, it depends upon the market. Like right now, high ends in San Francisco.
That was my answer.
Right.
That was my answer.
Right. Yep. Like right now, high ends in San Francisco are getting brutalized because people are like, oh, I probably shouldn't be paying $4,000 for a 100 square foot like postage stamp, you know? But then you find the middle tier ones doing like relatively decently. So I think high tier multifamilies in certain cities are gonna get hurt, but then the ones in the more affordable range, they should be doing decently. But that's a broad statement. So
sure. Yeah, well, multifamily is market specific, right? You can't just say, okay, all multifamily in the US is going to drop 5, 10, 20%,
Exactly.
Unless the debt markets change, because that governs all multifamily.
Right.
And I don't see that happening. You know, I think multifamily by market may change. My 2 cents. Sonia, real quick, we'll try and speed round through a few more questions here. Sonia wants to know, is it a good idea to refinance a home that is paid off to get the down payment for another property? What do you think?
Really good question. Because I'm conservative, I would say no. Because here's a couple things. Assuming this is her nest egg property she's living in right now, there are multiple things that could happen when you do this refinance. You pull cash out of your property. You have something that's paid off right now, and now you're going to encumber it with debt so that you can go get another investment. That other investment could turn out not working out for you. And then now you could lose that property, and then the property you currently have that you do need, you have more debt on this that you need to pay off. And then, for instance, let's say you get sick or unforeseen circumstances happen, and now you might lose your job. Now you have more debt on an asset that's already paid off and free and clear. There are people who do encumber their properties that are already paid off, and that's fine thing to do. But like I would say, Sonia, if there are ways for you to figure out ways to save more money without you having to encumber your main nest egg, I would consider it.
Great. Okay, I would agree with that because it's all about the risk factors here.
Yep.
Vic Mundo had a great question here. What has been your most effective way of finding discount properties? Because, as has been said on the BiggerPockets podcast 100 times, you don't find a good deal, you make a good deal.
Right.
In that. So you've got to, not every deal on the market is a deal that's going to pay well or is going to make you cash flow or whatever. So you got to look a little harder to find good deals, especially when you're doing this thing, as a side wealth building effort, not full time. Mm-hmm. If you've got to make sure that you get into a good deal that's going to not suck out a bunch of your time. So
yes.
How do you find the deals that work for those that are investing with a full-time job?
That's really important. And you said the comment of something that's not going to waste your time.
Yes.
By having a full-time job, you're getting an hourly rate that's telling you like you're worth this much time at this job. And if you go to real estate and after looking for tons and tons of deals, you find a deal that's barely cash flowing and it's going to be paying you paying you like minimum wage. It doesn't take a rocket science to say, you know what, for that time I'm wasting in real estate, I could be retraining myself in my job, taking on more responsibility, getting a promotion, making more money. And then while the real estate market goes into maybe a correction or slows down, then the hourly rate I could get from investing in real estate might increase. So you always have that in the back of your mind. But also, I have found out that the real estate investors, if you're not come from a sales background in corporate and you're not experienced with that, you have to learn a concept called the funnel. And so what you always have to be thinking about is when you're looking at real estate opportunities, you want to say, okay, there are things such as leads, which unqualified leads, so something you get on MLS, something you get from a word of mouth or whatnot. And every time you look at an unqualified lead, we'll probably say maybe 10% of those unqualified leads, maybe 10% are worth you actually running the financial numbers on. And then of that number, then maybe of that, there's 10% you might make an offer on. And then of those 10% you make an offer on, maybe another 10% might get accepted or something. So as time goes on, more and more things are going to be disqualified out of your funnel. So what you have to do is, Vicmundo, you cannot just say, okay, well, I looked for 3 properties on MLS, or I spoke to one realtor and he said they'll get back to me and I haven't found anything. Think to yourself is, how do I constantly fill this funnel? And so people dog on the MLS a lot, but when things are really hot, MLS is really hard to find deals. When things slow down, you'll find opportunities on there, but you should be checking the MLS. You should be speaking to real estate agents that are investor friendly. Now, a lot of agents say they're investor friendly because everyone says that, it's hip, but a true investor friendly agent will actually have their own feelers on the ground and their own bird dogs who are bringing them off market properties and then putting them on a spreadsheet and sharing them with you saying, hey, before these list out, here's what I found. Another thing you can do, untapped resource people don't talk about, is property managers. In some states, property managers need a real estate license. So if you tell them hey, I know your game is to just manage properties, but you probably have tons of landlords who want to get out of the game or want to retire and they want to sell. If you can just let me know about that, I'll give you full commission, no question asked if this deal closes. So those are some tactics.
Great idea. Great idea. And also, I found that property managers a lot of times know when some of their clients are tired and just don't want to deal with it anymore, or want to cash out or whatever. And the property manager may not want to buy the property themselves and may want to help this owner of theirs refer to another buyer. And obviously, then they get to they can continue to manage the property. If they find a seller, they'll hopefully negotiate a PM contract for themselves as well. So they get to continue to maintain the asset, make their PM fee, and also make a commission on the sale too. It's a win-win across the board, right? One last question, and this ties in to finding deals. And this is just another facet for finding deal. This is from John Yu, coming in and off of YouTube as well. What are your thoughts on using websites like Roofstock that offer turnkey properties for people that are working full-time in coastal cities like New York City? Or would you suggest trying to buy long distance? So in general, Roofstock and things like that for buying and maybe in bigger cities, or perhaps using Roofstock. Of course, you can use Roofstock for buying in more tertiary markets too. What are your thoughts on sites like I'll just use them, I'll list them out, Roofstock, just realtor.com, or other just direct turnkey sites. What are your thoughts?
Yeah. When it comes to the turnkey sites, I mean, they're in the business of selling you a property so they can get their commission and get out. And so the numbers that they present to you, don't take them as gospel truth. So if Roofstock says, oh yeah, this thing's going to rent for $1,200, go out there, do your own due diligence by just going on Zillow, looking at properties in the area, seeing what they rent per square foot, and run comparables to make sure that makes sense. See if you can get your own third-party inspectors on the property and take a look at things like that. Like, do your own due diligence upon this deal. Don't take everything like for face value. I know there's people who've used these portals before and have found success, but it's because they've actually done their own due diligence on the side. And they've market tested those numbers, because they can put anything they want on there to make it look good. But at the end of the day, if you don't do your own due diligence, you could turn out that those numbers aren't going to hit your expectations.
Absolutely.
And then last thing about the long distance BRRRR strategy. I was looking at the BiggerPockets forums. There were people who were in the midst of BRRRR, like right when COVID started happening.
Yeah.
People were like, property values don't always go up. They can go down. I'm like, yeah, it can happen. So you can miss you can miss your appraised value all the time with the BRRRR strategy, but doing long distance, you need to have a business partner or someone that you trust who can serve as a contractor or organize your contractors. Because if you're just hoping that some contractor that you just met is going to have your financial incentives at heart, you're wrong. So I think it's a pretty risky strategy unless you have a team on the ground who can actually execute upon it.
Awesome. Good stuff. So listen, I got a few questions of my own here that I'd like to throw out here. And what I also this happens almost every Facebook Live and YouTube session that we do here. We get so many folks that want to pick your brain because we've got these great guests that have lots of wealth of knowledge to share with us. And we end up getting more questions than we can get to in the hour of the show. And so what I've asked Jordan to do, and he's agreed to do it, and I know he's a busy man, but he's going to come in offline in about an hour or so, hour and a half, and he'll jump on the BiggerPockets Facebook page and jump on the BiggerPockets YouTube page, and he'll keep this conversation going with you guys. So keep your questions coming. Keep writing them in, and I think that Jordan will jump in a little bit, and he'll get some of your questions answered. So if you guys didn't get your questions answered live, fear not. He will come in and type in some answers to those things, so you guys can continue the conversation and talk about what the methodologies and strategies that we should all have if you're looking to build your real estate portfolio while you're also holding down a full-time job. Now, I'm going to be selfish and take the last two questions just because I think these are good ways to close it out. Number one, you've talked a lot about buy and hold investments while you're doing a full-time job. Have you ever, and if not, would you ever invest or take on a fix and flip or wholesaling activities while you are working in a full-time job?
Quick answer: if I didn't have a partner, no. For fix and flip, it becomes kind of a full-time job. And so people can say, like, you'll see like flip this house and someone makes like $20,000. It's like, oh, wow, you make $20,000. And you ask them, like, how much time did you put into that? And so you get $20,000 divided by their time, and it works out to making $675 an hour.
Like, I put in 3,000 hours.
Exactly. So fix and flip is another cash flow activity. So you'll hear a lot of people who will dog people work full-time jobs and say, like, well, I don't work a full-time job anymore, I'm independent. And then you look and you're like, oh, wait a minute, they're a realtor on the side. That's a cash flow activity. Because in real estate, there's only so much you can do by taking on much more and more leverage. You got to pay that debt down. So fix and flip, selling properties, consulting, all the different stuff are all cash flow activities that people are trying to do because they're envious of the job that you already have. If you want to start fix and flip, you would need someone who's a contractor, who's experienced, who can actually execute upon these deals. If you're trying to do it independently, it's going to be a lot of time to spin up. I'm sure people who've done it before, but it just takes a lot of dedicated time, which I think would be better served if you actually just focus more on your job and invest in buy and hold REITs or syndications.
Got it. Okay, great. And I would say the same thing for wholesaling, because wholesaling is, you got to be Johnny on the spot when that buyer or seller call up. You got to be able to, and if you're working, you can't like leave a work meeting to answer the call from the seller. That's not a sustainable type of position. In that you can be active in real estate, but I find that the activity you need to take on in real estate, if you're working a full-time job, needs to be flexible enough that you can take those actions before 9 and after 5.
So true.
You know, putting your property manager in a headlock on a rental that you have is a very easy activity you can do before 9 or after 5 o'clock.
Right.
And that's so totally agree.
Don't be Matt's property manager.
Yeah. Right.
I can imagine you giving me put me in a headlock right now.
Yeah. No. I'm the teddy bear of my group. I hire I have a gun for hire, a hammer that goes and puts him in. So I can be the good time guy. You know, that's how we run. Last thing, you had said this, I'll put you on the spot, about sometimes you gotta know, kind of read the tea leaves and decide that it's time to get in. And sometimes you got to pump the brakes. So given everything going on in this market, Jordan, all the COVID and recession and financial crisis and the dollar and all these other things, if you had to pick one right now, looking at today's market and your business strategy for yourself, are you looking to get in, or are you pumping the brakes right now?
Oh, I have to give you one of those cop-out answers.
Yeah, man, I know. I'm doing it. Go ahead, do it.
You should always have a position in the market. Like I have my position in the duplex. I have the other units I manage. I have the what's the thing called again? Mother-in-law. Sorry, English is tough, even though it's my first language. And so I have a position already, so I can be like cautious or whatnot.
Yes,
always be looking for opportunities. But if someone ever tells me like, I have a pile of money, I'm just going to wait it out. I knew people in 2012, 2013, 2014 who could have bought places to live in the Bay Area and start their families, but they wanted to wait out and see if prices would get cheaper. You always have to be looking at opportunities and just see if things can pencil out. But there's never going to be a situation where you say like, I'm all in. Like my family was buying, but probably like before the Depression, they were buying during stagflation issues. They're buying during the savings and loans, the slowdowns, the 90s. There's always activity going on. Now, there's some years that are faster than others, and there's some years that are slower than others. But you're always out there. You're always looking, and you're trying to seek opportunities.
Yeah. I think that's a great point. It's very hard to time the market. I sold all my stock because I was avoiding a market crash, and I'm glad that I sold it because I avoided the market crash. The only problem is, Jordan, I sold it in 2016. Right? So it's because I was like, oh, the market's going to crash, so let me sell everything. I've missed that enormous growth that we had in 2016 all the way up to 19, and that because you don't know. Again, all of our crystal balls are broken. We really don't know. Real estate could double in value in the next 5 years. I don't know if it's going to or not. Air quote seems unlikely, but a lot of things that have happened recently have seemed unlikely. Nobody had global pandemic in their underwriting. That's
a really good point. Two things I like. One is you're honest and talked about your position in 2016, because speaking any investor, we've all lost money. Like I lost about 25 grand right after I graduated college because I was trading some terrible penny stocks. It was really bad.
Nothing bad could happen with those things, right?
Exactly. I was following Warren Buffett advice, making good investments, and then I got greedy because I saw some kid make a ton of money and I lost everything.
Hey, I could do that too.
Thanks for being honest on that one. But
sure. It's just all about market. It's just a brief example about market timing. And if you guys have read my book, I'll get as vulnerable as I need to just to get a point across.
But then another aspect of like investing in real estate is also realizing that like when you're, and I say this over and over again to investors, is like, make sure you can keep yourself in the game and not taking death-line risk that's going to knock you out of the game. Don't always try to swing for home runs. If you can just get some singles here and there, like things are going to work out for you and you're going to do well. But if you try to put all your money into like one deal or try to swing for the fences and you miss, it's going to be terrible and you're going to set yourself way back.
Singles and doubles win baseball games.
Yep.
Singles and doubles win baseball games. Home runs, can win you. you know, but every here and again, you know, like if you just keep hitting singles and doubles, man, you round the bases real quick, you know? So, hey, this has been an awesome interview. I really appreciate having you on. I know we've had a lot of folks here that have left a lot of comments. Like I said, fear not, Jordan will jump on to Facebook and in YouTube in a little bit. And he will respond to your thoughts for those that we didn't get to live. So keep those questions coming in, because he's been kind enough to go and type in some answers to you guys so he can keep the conversation going. That's how we learn. We get in conversations. We talk to people that have walked a little bit of a road that we're trying to walk ourselves. So keep those questions coming in. Jordan, I know that you are the community manager for the Silicon Valley Investors Club. How else do folks get a hold of you if they want to pick your brain further, contact you, get into a conversation with you? How do folks reach out to you?
Yeah, so you can find me on the BiggerPockets blog. Right now, BiggerPockets has me like nose to the grindstone working on a book called how to work a full-time job and get involved in real estate investing. I almost choked on the whole entire title. So basically, kind of like what we're talking about here, but giving you more tactical steps on getting.
It could be such an exciting book. I hope they fast track that and get it out because I think it's going to be so timely. And in line with today's conversation, I'd love to have you back on the show once you get it out, because I think that it's so timely for folks that love what they do, but don't want to just rely on Wall Street to get themselves to their investment goals.
Exactly. They want their own control in their financial future. So you can find me at BiggerPockets or at svinvestorsclub.com. We have like a Facebook group and Twitter and whatnot. It's a place for current and former tech professionals to talk about different types of investing, from stocks, bonds, real estate, to what have you. So
cool. svinvestorsclub.com. Check that out. And keep an eye on Jordan Thibodeau here, guys. Look out for that book. Look out for his articles in the BiggerPockets blog. I've enjoyed them myself in that. So, guys, thank you for coming out. I will see y'all next Monday. And we'll have another great guest here for y'all to pick their brain and for another great real estate conversation for you guys to have. I appreciate you, BiggerPockets family, for being here to watch us. Jordan, thank you personally for being here on behalf of all of our hundreds of people watching right now. Thank you for your time.
Thank you for having me. I really appreciate it. And thank you to the BiggerPockets community for offering me this opportunity. Thank you so much.
Cool. Take care, guys.